on session 7 now, session 7 of International Accounting Code 425, session 7. And in this session, we're going to deal with performance evaluation in multinational corporations. Performance evaluation in multinational corporations. Recall that in the last session 6, we discussed extensively issues of financial statement analysis as regards multinational corporations. And we looked at what it means, the concept. We also look at the various techniques, that could be used in financial statement analysis. We also looked at separate financial statements and consolidating these financial statements to provide a holistic financial information about the group of companies. So when we see a consolidated financial statement of a multinational, we are looking at a financial statement that consists of the parent company and the subsidiaries being integrated into a single set of financial statement that provides information about the performance and financial position and changes in the financial position of the group of companies. So now we are going to look at session 7, and we are looking at the performance evaluation in multinational companies. What does it mean in the context? What does performance evaluation means in the context of multinational companies? So excuse me. Performance evaluation generally is aimed at facilitating periodic review of operations to ensure that the goal of the company is from the perspective of multinational companies, where you have the parent companies and the subsidiaries located in different environments, different with a geographical spread. What performance evaluation will do is to provide information, information for decision making, about the operations of the subsidiaries and the parent company, so that at the end of the day, by the time we look at this report, the performance evaluation report, it is now being gauged against the objective that has been set, or that was set for the respective units. So performance evaluation is a mechanism used to measure the actual performance against expected performance. Of course, we dealt with issues of budget, budget, and in budget we are making estimates. We are stating our plans in financial terms, and at the end of the day, performance evaluation will enable us to know whether these set objectives were performed, were achieved as expected, were underachieved or overachieved, as the case may be. So it provides opportunity for employees, for supervisors and all that to exchange ideas about their performances, to also identify areas of improvement that are necessary. Areas of improvement could be areas where trainings are needed, areas where key changes are needed to be able to have a better performance in the next reporting period. Benefits that we'll normally get from performance evaluation will include control of work that need to be done. It enables each unit, each manager, each supervisor, each whatever at whatever level, these reports are necessary to control activities. They also enhance employee motivation and commitment and productivity. They also help in identifying goals and objectives for for the employees of the company. It also a very good tool for satisfaction of basic human needs for recognition. We also say that it is a very good mechanism of achieving of identifying areas that need to be improved upon, areas in the entity that needs to be improved upon. All right, so we look at financial measures used by multinationals in evaluating foreign subsidiaries. These include budget as a success factor, profitability measures, sales growth and cost reduction. Three good measures as are highlighted here. 1, budget as a success indicator. 2, profitability measures. 3, sales growth and cost reduction. So these are some of the measures that multinationals use, the parent company uses to evaluate the performance of the subsidiaries operating in other geographical areas. Now let's look at profitability measures. This is an indicator of operating success. The profitability indices may be the gross profit, it may be the net income, it may be return on capital employed, it may be gross margin, and all that, So you have different, profitability measures. But the key thing here is that we are looking at it that this is one of the metrics used by the parent company to evaluate the performance of the subsidiaries. Now, sales growth and reduction is another one. The parent company, may set a target with regards to sales growth, or cost reduction, as the case may be. If the environment indicates that sales growth is not achievable, the next option would be to reduce costs, so that the overall objective may still be achieved. So these are very, very important issues. Customer loyalty to products and services are also issues that these are sub metrics that we can use also under sales growth and reduction. So increasing of market size may also be an objective or a goal to achieve. Reducing cost, using different mechanisms like outsourcing functions, like maybe abandoning certain products that are not producing or that are not yielding the desired results, so that the cost associated with that area is eliminated, and so on and so forth. So budget as a success factor is a management tool for controlling operations and forecasting future operations of domestic companies. So budgets are set. There are set objectives that the company within a specified period. So a budget being a forecast, you use it to compare the actual results with the budgeted figures. So a comparison of that producing variances that are being analyzed and evaluated for decision making. So let's look at issues to consider when we are developing multinational evaluation systems. So the issues are factors around the environmental differences are very, very important. Factors around environmental differences of the countries where the subsidiaries operate. So these factors could be legal, they could be political, they could be economic, they could be technological and cultural. So these factors are key when you are setting up an evaluation system. Also, you have to consider other variables like the transfer pricing, inflation that is in the country, foreign exchange issues. So all these are very, very important, because these are environmental issues that could impact on the performance of subsidiaries. Now, looking at transfer pricing as an issue, in practice, you see transactions that occur between the parent company and subsidiaries on the one hand, or between subsidiaries and another subsidiary on the other hand. These transactions, could be done at different prices. All right. So it is normal within the multinational group. It is normal to have transactions between the parent company and the subsidiaries, or between one subsidiary and another subsidiary. So these transactions may be affected at different transfer prices, of course, because we have different methods of transfer pricing, and a multinational may choose a particular transfer price to maximize their after-tax profit. All right. So because different transfer prices could yield to different results in terms of in terms of taxable profit. So the problem is that the tax laws and policies of these different countries are not the same. All right. So the tax authorities are interested in methods that are being used by these multinational companies, so that they would be able to determine whether these methods are detrimental to the tax policies of that country where the subsidiary is practicing now. So in practice, transfer pricing can be used to achieve different objectives. It can be used to achieve different objectives, including reducing taxes, taxes that are payable by that company. All right. So foreign currencies, we look at the challenges around foreign exchange problems. Especially in import-dependent countries, we note that foreign exchange challenges are very prevalent in these countries, because they are dependent on international variability of these currencies. So the problem of performance management and evaluation of foreign currency lies with the choice of currency for translation. So it's very important, and it's just an issue that needs to be considered when setting evaluation methods or techniques for subsidiaries. So multinationals need to translate their financial statements. Yes, they need to translate these financial statements of their subsidiaries into a consolidated statement. So to record the transactions that is measured in foreign currency, to prepare, we are looking at the reasons. We are looking at the reasons why multinationals need to translate the financial statements of their foreign subsidiaries, and we are saying that one of the reasons is that they need to record the transactions that is measured in foreign currency. Two, they need to prepare consolidated financial statements which report on the economic entity as a whole. Three, we said they need to evaluate the operations of a foreign business segment. They need to evaluate the operations of that segment of the business. Lastly, they need to evaluate the performance of management of that foreign subsidiary. So these are the reasons for translating financial statements of a foreign entity or a foreign subsidiary, by the multinationals. So we also need to look at issues of inflation. Inflation is a key issue. This is an external variable that is not within the control of management. So it is a macro issue, a macroeconomic issue. So inflationary pressure distort the figures and information in the financial statement. All right. Also, for objective financial performance, it is necessary that multinational consider the effect of inflation on the financial statement of these companies. Now, adjusting for inflation will, of course, pave way for a realistic evaluation of subsidiaries and management. So adjusting for inflation enables the multinational to get the real value of the performance of these foreign subsidiaries. Now let's look at the effect of the environmental factors. Effect of environmental factors. One is to achieve a real performance evaluation of subsidiaries. To achieve a real performance evaluation of subsidiaries, there is need to consider the environmental factors. There is need to do that because these environmental factors play a very big role in the performance. They have a big impact on the performance of foreign subsidiaries. So environments differ, of course we know. Environments differs in terms of politics, in terms of culture, in terms of legal, and all that. These factors, they do impact on management performance, either favorably or unfavorably. So to achieve a realistic evaluation, multinationals need to eliminate the effect of these environmental factors from the performance of their business. Otherwise, you have a suboptimal result in that evaluation exercise. So let's look at the responsibility accounting and performance evaluation in multinational corporations. Responsibility accounting, what is it? Responsibility accounting actually is a concept that looks at responsibility centers. A responsibility center is one that has control over cost and its revenue. All right, it's a center that has control over its costs and revenues. All right, so let's look at examples of responsibility centers. 1, cost centers. 2, revenue centers. And 3, profit centers. So these are the 3 key centers, 3 key responsibility centers that we know or that we have. Now, cost center. Let us explain cost center. Cost center. In a cost center, the cost center is able to control, its input cost. The cost center is able to control its input cost. Now, objectives are usually set, but in terms of quantity and quality, considering identifiable constraints on the inputs, such as time, standard cost, and all that. Now, in cost centers, performance is measured by the variance from a predetermined standard. All right, when you set the budget, you measure the budget against actual performance. So the performance of a cost center is measured by the variance of by the variance of the actual from a predetermined standard. So the system is based upon reasonable, attainable standards that is meant to suit the centers, and it is usually revised as the condition changes. Other quantitative, non-financial measures are often employed, such as number of machine breakdowns is an example. Number of employee turnovers and things like that. So qualitative assessment also may be made by the production department by using some surrogate measures, such as the number of grievances, on the or number of grievances as reported by the employees and all that. So this is, some of the qualitative assessment that we can get. So we have seen what the cost center, is all about. That the cost center is actually that center that's able to control how it has, control over, the input cost that comes to it, and that at the end of the day, there is, a measurement that, looks at the actual vis-a-vis the predetermined standards, and the variances are, analyzed. Now let's look at the revenue center. Now, by definition, a revenue center, can influence output levels. A revenue center can influence output in relation to input. All right, in relation to input, that is the resources represented in the budget. So, but it has no actual control. It has no direct control, over the cost of the products or services. All right, but we are saying here that the revenue center can influence the output levels. The output levels in relation, that's the output levels, which is the revenue, in relation to the input, that is the cost. But we are saying here that the revenue center has no direct control over the cost, which is, the input cost. The unit that has that direct control is the cost center. So that's it about the revenue center. So motivation and control is usually sought by means of budgeted revenues and expenses. So this twin objective are to maximize revenues while spending within authorized limits. While spending within authorized limits. Why? Because they do not have, that control over the input cost. So sales offices are, a typical example of, revenue centers. Sales offices. Often, you see them, most of them are, segmented along a product line. They are segmented along product lines or territories, or along sales, sales people, sales employee and all that, So profit centers, the profit centers, these are units or divisions that have control over both costs and revenues, all right? They have control over both costs and revenues. So performance evaluations, as far as profit centers are concerned, relates to the output, which is the revenue, and the input, which is the cost, and then and then we now look at the net position of it, which is in the profit. So profit usually is an absolute measure, so that can be assessed as as an indication of the firm's financial health. So as such, it becomes very, very meaningful, a very meaningful measure, when you are looking at it in relation to budgets, and then the results with, results of prior periods and all that, profits of other divisions and things like that. So essentially, we are saying here that the profit centers are that centers that have control over both revenues and cost. Therefore, with this, they are able to determine what the profit is all about. Profit being the revenue minus the cost. So where budgets are set, it is easier to determine the performance of profit centers by comparing the level of profit they have attained with what was earlier budgeted. And each division, in a case of different subsidiaries, can be one subsidiary can be evaluated or assessed, or their performance can be gauged against another, using these profit measures. All right. So with these, we have equally come to the end of session 7, of this course, and I want to say thank you very much for listening.